In the stock market you will find two groups of investors. One group wants to make a quick profit known as traders. The other group is there for the long term and known as investors. Both approaches have pros and cons. Here, we will try to find out which approach is more suitable for you. Stock trading. Stock trading is the buying and selling of stocks with the goal of making short-term profits. Stock traders look for opportunities to buy stocks at a low price and sell them at a higher price, often within the same day or even the same hour. Stock traders use various strategies, such as technical analysis and news-based trading, to make decisions about when to buy and sell. Stock trading is generally considered to be more risky than stock investing. Mainly, because trading is focused on short-term price movements, which can be more volatile and unpredictable. There are several ways to trade stocks. 5 most common strategies are as follows. Day trading. Short-term strategy in which an investor buys and sells stocks within the same day. Profits from short-term price moves. Swing trading. Medium-term strategy in which an investor holds on to stocks for a few days to a few weeks. Profits from intermediate price moves. Scalping. Very short-term strategy in which an investor holds on to stocks for just a few minutes or even seconds. Profits from small price moves. Momentum trading. Short-term strategy in which investors try to profit from the upward or downward price trend. Traders buy low and sell high in an upward trend and sell short in a downward trend. Buy and hold. Long-term strategy in which an investor buys stocks and holds for years. Benefits from the company's growth and dividends. Stock investing. Stock investing is the process of buying and holding stocks with the goal of building long-term wealth. Stock investors aim to buy stocks that they believe are undervalued and have the potential to grow in value over time. Stock investors generally have a longer time horizon than stock traders. Stock investors are willing to ride out short-term price fluctuations in the pursuit of long-term gains. Stock investing is generally considered to be less risky than stock trading. Mainly, because it is focused on the long-term performance of the company and the overall market. There are 4 common ways to do stock investing. 1. Individual stocks. Investors can buy and hold individual stocks that they believe have the potential to grow in value over time. 2. Mutual funds. Mutual funds are investment vehicles that pool together the money of many investors and use it to buy a diversified portfolio of stocks, bonds, and other securities. 3. Exchange-traded funds, ETFs. ETFs are similar to mutual funds in that they offer investors a way to buy a diversified portfolio of securities, but they are traded on stock exchanges like stocks. 4. Dividend reinvestment plans, DRIPs. Some companies have DRIPs, which allow investors to automatically reinvest their dividends in additional shares of the company's stock, rather than receiving the dividends in cash. DRIPs can be good to compound returns over a long time. The difference between stock trading and stock investing can be expressed in 3 key segments as follows. 1. Time horizon. Stock trading is focused on short-term price movements, while stock investing is focused on long-term growth and wealth building. 2. Risk level. Stock trading is generally considered to be more risky than stock investing because of its short-term focus and reliance on price fluctuations. 3. Strategies. Stock traders use various strategies, such as technical analysis and news-based trading, to make decisions about when to buy and sell. While stock investors focus on buying undervalued stocks with long-term growth potential. 4 key factors to consider to make right choice. 1. Financial goals. If your goal is to build long-term wealth, stock investing may be the better choice. If you are looking for short-term gains, stock trading may be more suitable. 2. Risk tolerance. Stock trading carries inherent risks and is not suitable for all investors. Carefully consider your risk tolerance and invest accordingly. 3. Time commitment. Trading needs more time and attention than investing. Traders need to monitor price movements and news events throughout the day. Investing can be a more passive approach. 4. Strategies. If you want to build wealth, then do fundamental analysis of underlying business and invest. If you want to profit from short-term market volatility, then do technical analysis and trading. It is important to carefully consider your financial goals and risk tolerance before investing in stocks. Thanks for watching. If you enjoyed our content, please like and share it. And don't forget to subscribe for more videos. We appreciate your support and can't wait to share even more amazing content with you.